question here.
Would you be able to roll credit spread like selling a naked option? Yeah, what you do is if you have a net credit, let's say you do something called a bear call spread, where you have a naked call essentially, but instead of being naked, you buy something above it in order to protect yourself in case it runs up on you, right? That's called a credit spread. So what you'll do then is, let's say you take in $200 of a credit, right? And let's say today's Thursday, and today's a perfect example. Today is Thursday. Let's say it's down to $10. Are you going to risk a market moving event tomorrow just to receive $10 more? Probably not, right? So you would roll it in that case. You would close out your position and you would roll it out into another month. And that's what traders do all the time. One thing when you're trading options is you got to be very cognizant of expiration dates and when your stuff is coming off and what's in the money and what's out of the money in your portfolio. This way you could constantly add things and roll things, do stuff like you just mentioned.
I have two questions. Let's say we put on a spread. Is there any moment where you would lift the premium that you sold for a bigger gain?
You could do that if there's, what's funny is every time I've ever tried to do that, it rolled back over. It's like,
you remember the reason you put it on in the first place?
Yeah, it's like if you mess with something too much. I have a rule in my trading plan, and I don't necessarily want you guys to follow this. It's just something I do for my own mental health. I'm allowed to make one adjustment.
Oh, that's interesting.
I'll allow myself to make one adjustment. If I start tweaking stuff too much, you could go nuts. You know what I mean? Trying to go long, go short, trying to cover things at the right time. It just becomes like a little bit, instead of having a legitimate trading strategy, what you then have is something called an octopus, where you have all these different legs and all these different things going on. And you're not bullish or bearish, you just have an octopus, and that's not cool. So one of the suggestions, that's a good question. One of the things you can do, if you want to be more bullish, let's say something exceeds your expectations for whatever reason, it's breaking out to new highs, you didn't expect it, you expected the sideways game a little bit, it didn't happen. What you can do is just buy another call. So now you have, let's say, a 1-for-1 vertical, right? One call and one contract, let's say, sold against it, and then just buy another call. And then you'll have basically it's called a ratio back spread, basically. So now you have one call that could do it at once. It has unlimited upside, but yet you still have that a little bit of protection on the downside with that one call that you sold.